All right, before we head in, I put this up on Friday when I put the video up about CPI and PPI, but some people only watch the market outlook. Friday, June 14th at 8 a.m., the discount price for anybody in the CFA family is up. So the 320 price option is now open for any CFA charter holder. Any CFA candidate currently registered for an exam or registered for an exam up to 60 days ago. So if you were registered for the May exam, you would still qualify. And any individual that has at least CFA level 1 standing, documentation will be required for all three. But you get it at 320 versus 440. And just keep in mind, July 31st is the deadline for the all-included subscription. That is 45 days. And that would mean that you would have no extra fee for any content that I put out, because there will be some modules I put out that will have recurring fees. August 1st onward, the applied level is the same price, $320 for anyone in the CFA family, $440 otherwise, but recurring monthly fees for selected modules. The first one being my new positions, which will begin September 2024. Right now, I'm including a small version of new positions in the market outlook each week. This will be a more detailed view of what new positions I'm taking and what my thesis is for them. That would be $50 per month. So if you think about the first year alone, that would be $600. So that if you were in before July 31st, if you paid the $440, you get that. If not, August 1st, you have to be a subscriber first. Then you have to subscribe to whichever recurring module you want. You could see the savings there. And then peer groups, this is upcoming. I don't have a time frame on that, but sometime within the next 12 to 24 months, we'll start the peer groups. But we'll start here. We'll see how that works out. For those who are curious, the next sub-industry that I'm doing, I put a vote thing up on LinkedIn, and by far it was ocean shipping. Ocean shipping covers dry bulk. This is iron ore and grains, covers wet, which is crude oil, and covers container, which is Nike shoes and t-shirts. So dry bulk, wet, and container. And then there is some liquefied natural gas in there, but it is so small. Same with chemicals. There is some in there, but it is so small. These are tiny. The big ones by far, dry bulk, followed by wet, followed by container. That's pretty much the majority of shipping out there. So we'll constrain ourselves to those three. As far as the discounts go, we've coded as much as we possibly can, but it may not cover all contingencies. If you find that whatever you're updating is the system's not accepting whatever document you're putting in, it could be that you passed level 1 in 2006, 6, for example, and it was a different PDF than what is currently being issued now. The system would not recognize what this looks like because it's never read one before. That's okay. Just use support@markmeldrum.com and we can get that done. And it will also give us a chance to see what this looks like, again, if we don't have that covered, so that we can then code that in. 45 days. I'm going to remind you every week. So if you do want to get in, you got 45 days to get in. Once August 1st happens, if you say, I was never told, I'm gonna point you to all the videos in which I said again and again and again. We're gonna do the countdown. Next week, you know what this number will be? 38. I guarantee you. That's my forecast. We'll start again with a brief review of some of the economic data from last week. The big ones being inflation. I'd already put a video up about CPI, PPI, and the Fed, so I won't go into too much detail about that here. But inflation, core inflation month over month, came in lower than expectation. The headline inflation rate month over month lower than expectation. PPI followed suit. Let's just jump down to Friday. Export prices for May month over month, negative 0.06. Import prices month over month for May, negative 0.4. If we look at the export prices year over year, up 0.6. And if we look at import prices year over year, up 1.1, well below 2%, and month over month showing deflation. I showed you in the video earlier that I put up on Friday for core. If we looked at super core, that it actually had a negative sign in front of it. It had a couple of zeros because it was a percent. It was really small, but it was on the other side of the zero line, showing ever so slight deflation. And it seems to make sense. You had strong job gains. Every month we have job gains. Well, every worker is producing some output, right? And if the worker is not producing more output than what they're getting paid to produce, well, they wouldn't have a job. So yes, you have wages going up, but as you hire each person, supply increases and increases and increases. And there is some evidence now in the auto industry showing deflation in both used cars and new cars, according to Cox Automotive. And they're looking at the average price of a used car, average price of a new car. Those are going down. Let's look at oil from last week. Oil imports up almost 2.6 million barrels. Inventory, crude oil stocks expected to have a drawdown of 1.55 million. Last month was a build. This month, look at the size of that build, 3.73 million barrels. Gasoline stocks expected to build by 1.25 million. Last month increased by, 1.25 million. Did I say a B on that? Million. Last month was 2.102 million. Big increase, 2.566 million. Continuing jobless claims, 1790 expected increase to 18, actually increased to 1820, an increase of 30,000 month over month. Week over week. That's for June 1st. This is just in a week. Initial jobless claims, 229, expected to moderate to 225, actually went to 242. Let's combine this stuff here with consumer sentiment. 69.1, expecting an increase in consumer sentiment, actually had a decrease, and not a small decrease. That is a fairly large decrease from 69 down to 65. 5-year inflation expectations increased to 3.1, which is counter to what we've seen, but I don't know if they had when this survey was done, if they had the benefit of seeing these more recent inflation numbers. Consumer expectations, 68.8, expected an increase down to 67.6. Current conditions, expected to hear that current conditions are pretty good, and 62.5 from 69.6. That's a big drop. So we have noticeable drop in consumer sentiment. We have increases in continuing claims and initial jobless claims, bills in oil and gasoline, prices coming down, average price for vehicles coming down. This sounds like demand is dropping at the same time supply is increasing. That is how you get shifts that quickly in average prices or baskets of prices, such as CPI, such as PPI, such as export prices, import prices, and we have PCE coming out at the end of the month, and there have been some significant downgrades to what's expected for PCE. PCE usually tracks lower than CPI because it is a slightly different basket with lower weights on what CPI would have as higher price pressure items or stickier items like shelter. It has a lower weight on shelter, so PCE usually comes in lower. It wouldn't be out of the realm to see some negative numbers on PCE and a significant drop. FOMC this week, summary of economic projections, the likely path of the federal funds rate. One rate cut, and the market being efficient decided, well, let's price it all in this week. Look at the 2-year out to the 30-year. You got one rate cut all along the long end of the curve, and the 1-year starting to price it in there. I don't think that that's what's going on. I think the market sort of has an idea based on the turn in the data in the last couple of weeks that the Fed will be presented with data that gives them the opportunity to cut more than once. I think that is sort of the interpretation going on. It's less about fighting the Fed. I think they believe the Fed when the Fed says we don't have the data, but I think the market is sort of thinking, but you will come to this conclusion. We believe that you're data dependent, but we believe the data will give you the opportunity. So the narrative at the end of the week was the market is fighting the Fed again. I don't think they're fighting the Fed. I think they agree with the Fed. You're data dependent, but they also think that no, the data will give you the opportunity. So they're already pricing that in. I'm in that camp. I think the data will give them the opportunity. The data lately have been more consistent on the demand side of being slightly softer than what we've seen, and on the supply side being slightly greater than what we've seen, such that we do have a case, I think, where demand is lower than supply in a number of different industries and sectors of the economy. So I think that continues. Curve inversion, 711 days. And the money market to capital market inversion, 594 days. Canada still inverted as well, but already starting the rate cuts. I think that continues this year. I think minimum you could look for from Bank of Canada this year is another 2. I think 3 are in the works. I've thought that since the beginning of the year that rates would be about 100 basis points lower in Canada by the end of the year. So I think 3. Well, I think you could pretty much guarantee 2 more, but I think 3. I still think the Fed is on track for 3 rate cuts this year. I'm not accepting the 1. The balance sheet, no change in the securities holding, still sitting at 6.7 trillion. Full balance sheet 259 trillion, up 3.2 billion. That's not much. This is still surprising. You have equity markets that just keep going up. You have meme stocks that seem to be coming back. And money market funds just keep climbing. Another 28 billion, up to 6.12 trillion. Retail up almost $1 billion. Institution up another 27 billion, up in every category. It is a nice yield though, 5.47. You can't argue with that. Nice risk-free place to be for the summer. 5.5%. Well, that's annualized, but still 5.5% with no risk on a market that seems valuation-wise quite stretched at this point. I was reading something on Barron's where they were talking about the S&P 500 and the 7 stocks. There are 7 stocks that have the greatest weighting, have an average forward multiple of 36, while the index has a forward multiple of 22. So you have massively increased concentration over the last little while. 3 stocks in the $3 trillion range now. Tesla not wanting to be outdone, claiming that it will be worth 10 times as much as the most valuable stock. 30 trillion, not to be outdone. With massive concentration and that kind of forward multiple, the question then becomes, well, what's the catalyst to go even higher? What's the catalyst to pay even more? Earnings don't seem to be creeping up at the pace that's needed to suggest that the multiple is justified because of where earnings are going to go. So I think that take the opportunity to say, well, let's slide over and get 5.5%. We have a shortened week this week. Wednesday is a holiday, so we have Monday, Tuesday, Thursday, Friday. Next FOMC, July 31st, is 45 days away. It just seems we had one, right? June 17th. The June minutes in 17 days. What are the odds for July? 87% that nothing happens, 12% that you get 25%. I expect this will creep up over time. December, look at the big change here. 1 cut or no cuts, or a maximum of 1 cut. Last week, 54.4%. Now down to 29.6%. A lot more weight has gone to at least 2 cuts, and more than 3 cuts went from 0.7, call it non-existent, to 2.5. It's got a foothold, still very small, but a foothold. I just don't see 3. I just don't see more than 3, but I think 2 or 3 is the right number. I think the market will coalesce around 2, but I still think 3 is the number here. As far as issuance that we have to pay attention to, Tuesday, the 20-year, and it's not really an important tenor, but there it is. We do have Fed speak this week, Monday, Harker and Cook. Tuesday, we've got 6, and Thursday, you only have 1. Effective federal funds rate still holding at 5.33. Reverse repo down another 8.5 billion, 386 billion from 395. Lowest is still 327 billion. That is April 15th. I don't think we're going to see a new low in June, because I think you have the 21st, and then you have the end of month, which is the 28th. It's not only just end of month, it's end of quarter. Usually this bills for the end of quarter, just for balance sheet window dressing, and then we're back to the races again. So if we're going to break the low here, it would be sometime in July, if you're going to get below that number. TGA 650 billion, big drop week over week, down 53 billion. Reserves 3.434 trillion, down 23 billion. So runoff still 33 months. That's going to be such a slow moving number that I really don't know if it's worth tracking. But every time I do this screen, I think, well, it's only a little bit more writing, let's put it in there. But at some point, I think it'll just disappear. Okay, real rates, all down. We still have an inversion from the 5 to the 10. It's actually grown larger now, 8 basis points. And this is the right move. Inflation expectations or break-even rates all lower. Fed funds rate, Q2 is basically over 0. Well, that's in the history books, right? We can stop writing Q2 in there, I think. So Q3, Q4, and then we'll just add Q1 to the end. 19, 31 for a total of 50. Two rate cuts in here, looking at Fed funds futures versus 25 based on, I shouldn't say based on the FOMC. There's not agreement that there is one rate cut. There is a range that is given where the median is one rate cut, the median, but there's not consensus that it's one. It's just the median that's one. So rather than saying the FOMC is at one rate cut, the median of the range is at one rate cut. 50 is still within the range that they've offered. There are a number of participants that are at 50 basis points. So I don't know that the market is fighting the Fed, as we keep hearing in commentary, in as much as they are siding with one side of the range, well within what members on the FOMC have said. Last week was 36, now it's 50, Q1 30 basis points. So over the next 3 quarters, 3 rate cuts. Well, if we say 1 year, but it's really not 1 year. This is 0.75 years, because Q2 is basically done. Look at TLT, up 3.46%. That is pretty impressive. You had CPI, you had a little bit of reaction on the Fed, you had PPI, and then it continued on Friday with the import data and export data all showing deflation, negative signs on their prices month over month. Implied volatility really coming in. Look at that, 91%. 74 and 53 on the 13, 26, 52, up from 48 on the 13, which means we must be getting some kind of smile. I didn't look at the skew to see if that's what was going on. SPX up 1.58%, ending Friday again all-time high. 30-year fixed rate mortgage back under 7, 6.99. 6.95. Last week was 6.99. 10-year Treasury dropped 4 basis points over that period of time. The 30-year fixed rate dropped 4. Spread did not change, still sitting at 271. Looking at the mortgage REITs, agency up 1.35% over the week on an unchanged spread. That is a reflection of just expectation of lower rates. Annaly up 2.43. I had sold $19 puts on this one. And ABR up 1.26%, still holding around the 1350 mark, which I think it should trade at a slight premium to its book value of 1306, but heading up to 14 and 15 I think was a little too much too soon. This is a big number here. Mortgage apps for June 7th up 15.6%. That is a big number. Wednesday, market is closed. We get the National Association of Home Builders Housing Market Index. Previous was 45, showing the housing market in contraction. Thursday, building permits and housing starts for May, and Friday, existing home sales being reported for May. If you want boredom, watching paint dry, look at OAS's. IG, no change. High yield, no change. Double A, no change. Triple B, hey, there's a basis point increase for you. Double B, there's a basis point increase for you. Like, this has got to be the most boring. As I was entering these numbers and going, are we going to get a perfect sweep this week with no change? And then Triple C contracting 7 basis points. Let's talk about some new positions. And there are 2 more that I'm looking at. I'm not going to tell you which. I'm not going to tell you one of them yet. It's a British stock listed on the London Stock Exchange. It looks interesting. It looks pretty good, but I'm not ready to say anything about it yet because for many of you, I don't know if it's going to be a tradable security. So I have to find a way that makes sense to trade it. And then another one is a theme. I'll describe that theme shortly. I just haven't found the target for the theme, but it is a theme. I wish there was an ETF that tracked this theme so that I could short that ETF. Let's look at new positions. CapREIT. I added another 27,000 shares. You'll remember I was saying that I was hoping it would continue to be weak and even go down to 40 or 39 because I'd like to have like 60, 70, 80,000 shares. I added 27,000. I have now long position of 62,100 shares. I have total puts of 600 for another 60,000 shares. The average strike is 45.08. I have 300 at the 46. I have 150 at the 44. I just multiplied them out by the strike and divided by 600. The average strike is 45.08. My average premium is 172 across all of them. So my average put price would be 43.36 if they were all put to me. We're at 43.69. That doesn't mean they won't be put to me. I have strikes from 43, 44, 45, and 46. But if you take the average, it's 45.08 sitting up here because this one's got 300. So as it stands right now, I could close them all at a profit, some at a loss, some at a profit, but I'm not. If they're put to me, they're put to me. I am perfectly happy with that. I should explain why I'm so bullish on CapREIT. They do have a large exposure to Ontario. They're diversified across Canada, but they have exposure to 2 provinces that have rent control. Some 45% is in Ontario, and Ontario has rent control of 2.5%, and turnover is very, very low. When rents go up, turnover drops. So if you are renting an apartment and then you renew, you can only get an increase of 2.5% in Ontario under one condition. And that condition is the apartment that you're occupying was in existence before November 15th, 2018. That's a very important date, November 15th, 2018 in Ontario. Before that date, that apartment is rent controlled. After that date, it is not. So if you have a building that was built in 2022 and you decide to renew your rent, it can reset to market rents. It does not have to stay within the 2.5%. It can reset to the market, whatever that happens to be. So what is CapREIT doing with its capital recycling program? Imagine that you can take all the buildings in Ontario and you stack them in terms of age. And you draw a line, you say, okay, these are all rent controlled, these are not. What it's doing is it's building new apartment buildings and selling the old ones. Building new ones, selling the old ones. So it's slowly replacing its, call it fleet of apartment buildings with units that are not rent controlled so that it can continually reprice at market because the cutoff date is still November 15, 2018. So anything older than that, go ahead and sell it and replace it with something newer. Newer buildings require less maintenance capex than older buildings. Newer buildings are more energy efficient than older buildings, and newer buildings have no rent control versus older buildings. You win on three fronts. I don't know if the market has fully appreciated this strategy yet. If you look at their financials year over year, the number of units they have year over year dropped. But their net operating income increased because the units they got rid of were rent controlled. The units they added were not rent controlled. Beautiful strategy. If you take a rent controlled unit and you put CapEx in that unit, you can then apply for another, on top of the 2.5, another 3% rent increase once. But if you just build a whole new building, you have no rent control. That's the beautiful thing about cap rate. I will gladly take the 60,000 shares if they're put to me. It is my highest conviction trade. If I had to rank all my trades in terms of conviction, I don't think I have a higher conviction than this. Let me sweeten the deal a little bit more. It's got a 3.3% dividend yield. The forms I got last year, because I did own it for part of last year, 50% of it is return of capital, non-taxable. The other 50% is called a capital gain, which only had a 50% inclusion. Well, now it's going to have a 66% inclusion rate, but that is taxed at a lower rate. You'll end up paying a lower rate than you would with the dividend, because the dividend, if it was called that, is a non-qualifying dividend because the REIT doesn't pay tax. So because of the capital recycling program, you have return of capital and you have capital gains. So the dividend becomes very tax efficient versus, let's say, getting 4% interest. I'd rather get the 3.3% cap rate dividend, because it's called return of capital and capital gain, than I would a 4% interest income, because interest is 100% taxable, right? So if you, for me, I'm not worried about the tax, but for other Canadian investors, if you're worried about the tax efficiency of getting that dividend, it is probably one of the most tax efficient dividends in the REIT space that you're going to find. That's why I like cap rate. Tyson Foods, 52.50 puts. I got 70 cents. They dropped quite a bit. Why? Because their CFO got charged for DUI. So get rid of him. Get a new one in there. It was his second brush with something to do with the law. I forget what his first one was, but it's time for them to go. I think it was nepotism for the CFO. It's something to do with the family, the grandson of the original founder or something like that. Wow, enough is enough. I don't see that as a negative. I don't see that as a trend. I see that as a one-time event. That's not a Tyson Foods problem. That is an individual's problem, and the individual is gone. So I took the opportunity to sell 52.50 puts on Tyson. AT&T, $18 puts at 71 cents. I actually got 72, but after costs, my average is 71 cents. I'm looking to add at 92 cents if AT&T continues to drop. Why is it dropping? AT&T has a lot of debt, but they recognize they have a lot of debt, which is why I like them, because they are working to solve their debt problem. They do recognize that they have a lot of debt and are working to fix it and push their balance sheet back up to investment grade. The price drop came from the one rate cut, right? More rate cuts are going to favor AT&T. The market seems to think there's more than one rate cut in there, but AT&T investors, every stock has its own investor group. Every stock has its own behavioral characteristics. So it's not as if, you see NVIDIA and Tesla and MicroStrategy move a certain way. That's how stocks move. Every stock has its own clientele and will have a clientele effect. The clientele in AT&T is probably more boring, more institutional, more pension related. Is probably not going to do a lot to disagree with the median, and is probably positioning based on that. So hopefully a little bit more weakness in AT&T. Maybe we see it push back down to the $17 level, I will add the $18 puts. I'll add at 92 cents, and I may even be able to add $17 puts depending on where it goes. GM, I added 44 puts. They announced another $6 billion stock buyback. Last year they announced $10 billion. They were getting no respect from the market. Had good earnings, better guidance. Still we're sitting around 45, getting no respect again. Lower multiple than Ford, and they're a more productive company than Ford and a more profitable company than Ford, but a lower multiple than Ford. And I said it, they did one buyback, they won't stop, they're going to keep doing it, and they did it again, $6 billion. I didn't expect it this quickly. I really didn't. It was a shock to me when I saw it. I said, this is a fourth quarter thing you should be doing, but okay, another $6 billion. They ran up to over 48 and then pulled back quite a bit. So I took the opportunity at 44 puts for 45 cents. I will add, if they start pushing back down to 44, I will continue to add at 44. Borg Warner, I added more at the 32.50 put. I got $1.20 for that. I have the 35 puts, and now I've added the 32.50 puts. There seemed to be this idea that they're going to suffer along with EVs in that there's so much overcapacity. There's going to be some pullback somewhere. Someone's going to start pulling back on building so much, but 80% of their revenue, some 79 or 80%, still come from ICE. So I think the market has it wrong on that one. And on my watch list, I'm still watching the peso for the 19 to 1950 range. The central bank has already said they will step in if the currency continues with this volatility. That's all I need to hear. I'm good with that. And the peso did seem to get some support there, pulled back from the 19 to 18.5, 18.4. I think I saw an 18.3 print at one point, but still is kind of not sure about the new leader. Being that the central bank has already said that they're a little bit concerned about that, I will take a long position in the peso somewhere in the 19 to 1950 range. But, it's not an absolute. 19 to 1950 is what I'm looking for with no change in information. However, if something comes out, if there's a change in information that pushes it to 19 to 1950, well, then I have to assess what that change in information means, right? But given what I know now, I would pick it up between 19 and 1950. Newer information that comes out in the market may change my mind, and I may say, whoa, I'm not interested in this anymore, or it may not have any effect, but it's all conditioned on, given what I know now, this is what I would do. But there may be something that changes the what I know now condition. The CAD 139, we're at 137.5. I see 139. I would take a long position in the CAD only because I don't think the interest rate differential is going to get that large. I said the Bank of Canada is probably going to cut, I think, 100 basis points this year. And the thinking is, well, if the Fed is on hold and only one cut, this interest rate differential between the Canadian and the U.S. is only going to widen. That's the biggest driver of exchange rates, is the interest rate differential. Well, I don't think that's true. I think that in time the data will show the Fed can cut as well. So I think the interest rate differential is probably not going to widen anything more than what it is right now. So if it does hit 139 on the belief of a widening differential, I will take that bet. COMEX, looking at a straddle on COMEX, selling the $40 put and the $48 call. I'm looking to get $1 to $1.10 for that. If you've well, I don't know that anybody would be doing that straddle, but if you put in that straddle, you'll see, if you see 105, 110, that's me sitting at 105, 110 for 50 to 100 of these. Reason why is a differential between short-term supply versus long-term supply. There is a lot of short-term supply. It's long-term supply that is a problem. So being that long term is a problem, I'll grab it under $40. Being that short term is not a problem, being that this would be the July straddle, I will sell the $48 calls and feel quite comfortable with that. Plus I've sold calls on FCX, so if FCX is put to me and COMEX does rally, it's not going to rally without FCX rallying. So in essence, I would be hedged on that 48 call by a long position on FCX. I just don't see it above 48 by July, given the levels of inventory you have in Shanghai, given the production levels in the world right now, and given that there is no shortage today. There will be. If we continue on with the energy transition, if you continue on with AI, if you continue on with electric vehicles, autonomous vehicles, you are going to need more and more copper. You will run out. They're just the supply doesn't exist in the world unless you get the price of copper higher to turn resources into reserves. And then those reserves have to be economically feasible to get out of the ground. That only happens at higher prices. But that's not going to happen by July expiration. So I'm more than happy getting that straddle. If I got to get aggressive, I'll go down to 95 cents to get the straddle, but I'm hoping that there'll be a slight increase in volatility so that the premiums on both the put and the call increase just enough for me to get into about $1 to $1.10, but I'll take 95 cents if I have to. The spread on this is about 25 cents, 20 to 25 cents. So if it's at $1, the other side's 75 to 80 cents. I'm not crossing that spread. I'll wait for it to come to me. Now the theme that that I would like to get short on is this theme of what is called personalized pricing. I've been angry about this for quite some time, is that you can have two people side by side looking at the same product and they will pay different prices. I see this with traveling. I pay for one person and myself, and when it comes to checking bag, one person pays 35, I pay 50. How come I'm paying $50 and someone else is paying 35? It's because the algorithm has already figured out that I'm older. And that I'm older, wealth correlates with age. I've got more money, so I pay more. For no other reason than the algorithm has figured out that I just have more, so I pay more. Recently, the McDonald's app has come under a bit of fire for doing the same thing. If you sign up on the McDonald's app, you are told that you're going to get discounts until the app figures out when you're most likely to buy. Then no discounts happen to you because you're most likely to buy. The more nefarious thing in that app is there is code in there to figure out or try to figure out what day you get paid on so that it can target you on payday when you're flush with money. Go to Amazon, have 3 people with laptops. Just get 2 of your friends to come over to your house, sit at the table and just say, okay, let's look this up now. And it would not surprise me if your other 2 friends have different lifestyles than you and different levels of income and different browsing histories. Would not surprise me that you get 3 different prices, with the more affluent one of you paying the higher price. More and more I'm hearing grumblings about this. It won't be long before a regulator comes along and says, this sounds illegal to me. It won't be long before a politician says, enough of this. Just because I live on this street and you live on that street, I must pay more for the very same thing. And if we think that the digital world will become a bigger and bigger part of our world, this personalized pricing is really, nothing more than New Jersey appliance store where you say, how much is this fridge? And they say, I don't know, how much you got? Right? And this is basically what we're being held hostage to, is when we want to buy something, the algorithm asks the question, how much you got? And based on your history. So now it's not a matter of using your data to target you with better ads that are more relevant for you. It's using your data and weaponizing it against you to extract the most amount of money they think you're willing to pay, regardless of what they're delivering. So it's not a question of, it costs us this much, this is the value we think you're going to receive, here's our price. It's how much you got. What's your data history been like? What do we know about you? There's growing backlash against that, and you have to admit, if you're one of these people who have paid more than somebody else for no other reason than the company has weaponized your data against you, it doesn't feel good. That has been driving earnings in some companies. Dynamic pricing, personalized pricing, our algorithms figured out this, and as an investor you think, yeah, that's great, but the consumer's on the other side. The consumer is going to want protection from that, and I guarantee you every politician out there has had that happen to them as well. I'm sure all of you have stories of, yeah, I paid this and my neighbor paid that, or I paid this and my brother looked up the same thing and we had two different prices. Everybody's got a story about that, and nobody wants to pay a higher price for no other reason than the algorithm thinks that they got the money in their pocket. There is going to be regulation on this. There's going to be something. So if there was a group of companies whose revenue was, mostly derived from personalized pricing, stick them in a thematic ETF. I would short that ETF in half a second, because I think the writing is on the wall for that. The voices are getting louder, and there is going to be pushback against that type of pricing. It'll start small, but it'll snowball very quickly, and one or two companies are going to be made an example of, and every other company I think will fall in line. So right now I have nothing. That's the theme. If you can think of a theme, or you can name a company who's notorious for doing this kind of thing, but they can't have other revenues. So Amazon is notorious for this. Air Canada is notorious for this. But they're hard to short because Amazon has AWS, right? So this discriminating pricing that they're doing ends up being a small part of what they do in terms of the profitability of the company. So shorting Amazon, you're shorting AWS. It's kind of a neat little thing they got there, is you can't short us because you're shorting something serious, right, for something small. Air Canada you could probably short, but for many people in Canada, Air Canada is your only choice. We don't choose Air Canada. We have no choice. We must be spit on by them. Otherwise, if there was a choice, we certainly would take it. I take Air Transat anytime I can over Air Canada. Air Canada's got to be the worst, because they do recognize that you're not a customer, you're a target. You're a mark. That's all you are, and it's a matter of how do we get the money out of you. For example, in the app, $35 for one checked bag. Go ahead and check that bag for $35. You cannot. You have to do it at the airport. Well, when you get at the airport, it's $50. Why? Because where are you going to go? Where are you going to go? You got to pay it now. So you think it's $35, but when you get to the airport, it's $30. You cannot buy it in the app for $35. You can never buy it in the app for $35. That's how they get you. So the first bag is $35 in the app, the second bag is $50. When you get to the airport, the first bag is $50, the second bag is $70. You see that? They get you. And it's just a lie. Now I want you to think about this. Somebody somewhere thought that up. There's somebody sitting in a room that thought that up. Hey, why don't we do this? We'll say it's this much, but don't give them the chance to do it. But when they show up, let's hit them with 50, because, well, they're there now. They're going to pay for the convenience of it. Right? The convenience pricing, well, it's 50. It's convenient. You want to take your bag on the plane with you. But somebody thought it up. Somebody thought of doing that. I know somebody who has subscriptions to certain types of services, and it's been like over a year. They still can't cancel. They can't find a way to cancel. That's another thing that I would short as well. This is the ugly face of capitalism. That when you're sneaking in between and you're trying to get that done. If I could short all of those things, all of these things of individual pricing, personalized pricing, dynamic pricing, if there was an ETF, I would do it. So I don't know how to get this done. I'm still looking, but I'm going to at some point find a company where their whole revenue model is based on discriminating pricing. And I think that company, more than anything, will be a short. Okay, Tesla. Let's spend some time here because some really wild claims came out last week and over the weekend. Musk answered somebody's tweet with another really wild claim. 1 week, Tesla is up 0.3% on ahead of the shareholder vote. Musk started saying, my pay package is going to pass, and up it went. And when it was clear that it was, then there was another jump in the stock. Now, a deal's a deal. They made the deal. No matter how crazy the deal was when they made it, they made the deal. The judge should never have avoided that deal. I agree with that. But I disagree with the euphoria on this one, because what you're saying is, yay, we're getting diluted some 10%. Yay, let's push the price of this up. We're getting diluted some 10%. I think some sanity came into the stock going into the end of the week. Plus, what is telling on this is what is not working anymore. The hyperbolic speaking is not working anymore. No one believes that anything is just around the corner anymore, and no one is believing the wild claims being made. It's just not showing up in the stock anymore. In fact, it's almost becoming a negative. ARK has an $8 trillion price target on Tesla for 5 years. $8 trillion, 16 times more valuable than what it currently is right now. Musk says 8. We could be worth 25 to 30 trillion dollars someday. And now he didn't say those numbers specifically. He said we could be worth 10 times more than the most valuable stock right now. That's 3.2 trillion, so 32 trillion, 25 trillion alone he sees on Optimus. Next year, he'll have over 1,000 Optimi in Tesla factories in 2025. Over 1,000 of them. 1,000 to 2,000, depending on the story that you listen to. From barely folding that shirt with somebody controlling Optimi off screen, or the Optimus off screen, to suddenly a couple thousand of them working in the factories. You want to buy that car? Where Boeing has a hard time keeping the sides of their planes on the plane as they're flying, and that's with humans. You wanna work on that car? There are companies that are far more advanced than Tesla's. Now, you can have robots, but what he is saying specifically is these humanoid robots. Robots built as humans. I mean, car factories are full of robots, very special purpose robots that don't look like humans. It's a lot of robotics in there, but humanoid robots. And his other claim is that the global market for humanoid robots is going to be about 1 billion. Figuring there, that's 1 in 8 people will have a humanoid robot. Average over the world of about 4 people per household. Basically 50% of households will have a robot that he feels is $20,000. Numbers that just don't make any sense at all in time frames that are ridiculous. They'll be in households by 2026, fully programmable. In 2 years, you're going to have this several 100-pound robot walking around with kids in the house. One accident. That's not going to happen. It's just not going to happen. Robotaxi alone, he thinks, can add $5 to $7 trillion to the valuation. $5 to $7 trillion. That's 2 Apples, or 2 Microsofts, or 2 Nvidias. But to put it in perspective, 2 Microsofts, 2 Apples. Think of that. Just the robotaxi alone. And it's not so much the robotaxi, but the robotaxi platform that somehow, coming out of nowhere, they're going to be in a better position than Uber. If anyone is going to get this done, if there are self-driving cars out there, it is going to be an Uber. What else have we got? Silicon claim in their work designing their chips. Tesla is so far ahead of NVIDIA on this. They're ahead of NVIDIA on this. You have companies that have been in this industry for decades getting their ass kicked by NVIDIA. AMD can't catch up. Intel, I don't even know if Intel's working on a GPU, but AMD is. You have deep benches of experience, but somehow this company just shows up and they will be faster, a much better product, and cheaper than others. and they're so much further ahead of NVIDIA on this. Like some of the claims that are being made now, you read this and you think it sounds like Donald Trump talking. They're just eye rolls now. 1 year return negative 30%. Average analyst price target at the beginning of the year was 226. Average analyst price target now is 181. I think as a car company, just a car company now, less than 20 bucks. If you add energy storage on, maybe you can get to about 30, maybe to 35. And some of these venture capital claims, I don't know, maybe add $10 for that, because these are decades in the future. Maybe it's a $45 to $50 stock today. Not 170, not 177. So how can we make sense of this? We have to first look at this thing over here. ARC's $2,600 price target, $8 trillion market cap. I don't know if they factored in the dilution that would happen over time, but let's say 8 trillion. Who is that for? Is that even real? And it is not. I don't think a serious price target. In other words, I don't think it's the truth. I think it's an illusion. And I'll explain the idea behind truth and illusion shortly. Tesla has a large retail investor group. MicroStrategy has a large retail investor group. And here, the facts don't really matter. For example, I'm going to give you some facts about full self-driving. And this is from experts, because I've searched and searched and searched, and I've listened to a lot of different experts, and these are people with PhDs in this kind of stuff talking. Getting to 80% is easy. Almost every car company can get to 80%, meaning that the car will be able to handle 80% of the situations it encounters. 80%. It's the detail in the 20% that really matters, right? But 80% of the time, you're just driving in a straight line down a road, right? Getting to 90% requires data and requires a skill to get to 90%, so that the car can handle 90% of everything that it finds. Getting to 95 is brutally difficult. Brutally difficult. Getting to 100% is impossible, given the current state of technology today and where everything is today. It's zero probability. It is impossible. However, they do counter with, you don't need to be 100%. And because no driver is 100%. If they were, there'd be no accidents. There are accidents. All you have to do is get to a point where you can demonstrate that you are safer than a driver, which seems to make a lot of sense. But then they did counter back with, however, it just requires one death. One death, and regulators will be all over this. One death. That's it. A human making a mistake is forgivable. A machine making a mistake is a problem that needs to be fixed. All it requires is one death. And let's go a little bit further. Let's say it's one child that is dead. And let's go one step further, and let's say it's one cute child that's dead, whose picture is on the news all the time. The self-driving vehicle did not stop and ran over this child or killed this child. That's all it takes, is that. And you could say, but 20 children die a year from car accidents. It's only been 3 years, or it's been 3 years, and only one child has died from a self-driving car. It wouldn't matter. It wouldn't matter. How do you get to 100%, they say? Is the vehicle with a lot of work can get to 95%. The grid with a lot of work can probably get to 95%. It is the intersection of the two. You need a lot of connected devices being able to talk to each other. You need a grid that is smart. You need everything being able to communicate with everything else. For that, you need very high-speed communication, millimeter wave technology, which really isn't there yet on the entire grid. Which maybe you don't need it on the entire grid. You need it in the congested areas, which you could probably get away with. But today it's not there. Now the thinking is, well, if you put all of the computing power into the car, you wouldn't need the grid to have that kind of communication network. You wouldn't need that kind of high-speed computing, because rather than sending the signal back to a server to process a situation and then wait for a reply, you could process it right on the car. And they counter back with, well, great, you want to put processing on the car, that requires energy. So you're going to need a far bigger battery on the car just to handle the compute. You got double the size of that battery on the car to handle the compute. Otherwise, that compute will eat away that battery power in no time. There goes your range. Your range is gone. You'll be charging again and again and again, which will shorten the life of your battery. But if you double the size of your battery, you almost double the cost of getting that done. The price of the car goes straight up, and you will go through tires in no time because all of that weight. So their conclusion is, given the current technology today, it's impossible. It's not going to happen. It's decades into the future. Now that's the fact. Why does that have no effect? It's because the type of investor doesn't want to hear the facts. And I think that's what this is over here. This is not a fact. 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 This is illusion. To understand that, let's visit Plato. Plato, The Republic, Chapter 7, Allegory of the Cave. And I'll describe it to you briefly. You can YouTube this one. There's some really good explanations of it out there. But what you have is you have a cave with an opening up here, and you have a wall, and you have people chained to this wall, and they're staring at that wall. You have a fire going on back here, and you have people walking through here holding up objects whose reflection is cast on the wall. These people believe that is their reality, but it's just illusion. One person is released and dragged out of the cave, kicking and screaming, and is made to see the world and sees what it really is and realizes that everything that they've been seeing has just been an illusion. They have the facts now, and now they're allowed to go back down and tell these other people what's going on. And these other people look at him and say, weren't you just kicking and screaming a while ago? That looked kind of painful. And here you are talking all this nonsense because they can't imagine anything different than the reality that they've seen. So while this person is filling them up with the facts of what things really are, they will reject them. In fact, they will not only reject them, but they will agree amongst themselves that this person is a danger, and that if anyone tries to take them out, they will kill them. Because they see it as a threat to their security and their well-being. So even if you try to tell them the truth, they're not going to listen to it because they have their own reality. So that was meant to give you an idea of the difficult job of the philosopher in trying to enlighten a population, is that you will be met with hostility from people who say that doesn't match my reality, even if you are giving them the truth. So all you can do for them, and it ends up being a significant amount of the population, like 70%, is you tell them what they want to hear so that they remain peaceful. Tell them what they want to hear. Retail investor, tell them what they want to hear. $8 trillion, no, $30 trillion. Optimists will be all over the place. Full self-driving just around the corner. Now, based on the tweet that he put out this morning in answer to somebody else saying, why don't we have flying cars? He said the Roadster will be a flying car. This one that he's been promising, the new redesigned Roadster, for what, 8 years, 7 years, 8 years, just around the corner. It's just around the corner. Now it's going to fly. Now it's going to fly. There'll be 1 billion people on Mars in no time, based on what he said. $30 trillion company. Optimists will be everywhere. It'll be in everybody's home, and robo-taxis are just around the corner. That used to work for Tesla. He used to be able to just say something and the price would go up 20, 30 bucks. But all of this came out, he got his shareholder package, and then all of this stuff started coming out. He started saying this, we're ahead of NVIDIA, all this, and the market just wasn't buying it anymore. So maybe this retail investor is being told what they want to hear for so long, and without anything actually happening, they're now saying, wait a minute here. I mean, am I being played? All of these price targets are meant to play the retail investor. Speaking of playing the retail investor, price target out on MicroStrategy, $2,800. based on an active strategy with leverage with their Bitcoin. You can tell them all day long about the dilution effect of those of those convertible bonds, and they will not listen. So I hope it does get to that point, because I think that's just going to be a fantastic short. As far as Tesla, I'm still short on the risk reversal. I do believe I'm going to add to this position with probably either buying straight out puts on the stock 1 year out, or doing an at-the-money synthetic short, meaning that I would sell the call and buy the put. All of these promises used to do something to the stock. It's no longer doing anything. This reminds me of Beyond Meat, when the headlines just didn't work anymore, where they said partnership with Yum Brands in China, and you found out later on that it was just a test of 2 burgers in 3 restaurants for 4 days. It's like, but that's not a partnership, right? So I think it reminds me of that. Plus, Tesla today reminds me of Research in Motion, going back to 2008, 2009, when the market started realizing that the competition had better devices. And I think the competition and the marketplace is starting to look at all the other players in this space, especially in China, where Tesla is no longer the leader, but the follower in almost every dimension that you can imagine on the vehicle. One of the Chinese producers are more advanced than Tesla is on that. It reminds me of Research in Motion at that time, when the market decided that there's nothing here. The competition is way better. And it reminds me of Beyond Meat, when the headlines no longer worked in pushing up the stock price. Another all-time high on SPY, 542.82. Hit that on Friday. Putting it in perspective, 50-day moving average is 519.8, well above the 50-day moving average. The 200-day is at 481. If you had a 10% correction from these levels, it only gets you to 488, not the 200-day. Forward 4-quarter operating earnings, 253.42 from LSEG, 250.28 SPGlobal. Take the average of the two with the closing price, you get a forward multiple of 21.56. Up from 21.24. Surprise factor 8% would put it to 19.96 on the multiple. Forward multiple of 20 times, assuming that for the next 4 quarters, operating earnings come in 8% above the expectation. This is operating earnings. If we use as reported, the forecast is 227.09. You're almost 24 times the expected EPS, not operating earnings, but expected reported EPS of the market, 24 times. And the market is showing no fear on that one. 13-week implied volatility, 11%, 52, down to 4%. Shortened trading week this week, Wednesday off, Friday, triple witching, options expiration. Next week on earnings, or this week coming up on earnings, not that many companies reporting, only 7. SPGlobal would beg to differ and say there's only 3, and of course, Sector Spider, not wanting to be part of the crowd and wanting to be different, says there is 4. This is now just a complete joke. You have less than 10 companies, less than 5 really, and you can't get that right. Big data providers give us thousands of dollars of your money each year, but we can't get this right. Look how wrong, it's just a joke at this point. It's just a joke. Apple had one hell of a week, 8% up, week over week, $3.26 trillion. Nvidia, 9% up, $3.24 trillion. Microsoft also in the 3.2 trillion club. So there are 3 in the $3 trillion club. And Tesla not wanting to be outdone, as we said, it should be worth 10 times more than this, so 32 to 33 trillion. The interesting chart I saw from Bank of America, I can't replicate it, I can't take a screenshot of it because of where I saw it, but I'll try to draw it out. Median price, price forward multiple, and using z-scores going out to extreme points, and it looks like this, right? This kind of thing. And here we are. This was 2022 before the rate increases. This was there was one point in here, 2019, before the mini little correction we had there. 2006, 1999. These extreme positionings in equities were almost at that extreme positioning. Forward multiple, 21.5 operating earnings, 24 times reported earnings, meme stock craze coming back, ridiculous price targets coming in. It seems like the euphoria is back in the market. I would be very cautious at these levels, and to really cement it, no fear and large elevation off of the 200-day moving average. Markets correct for all sorts of reasons, sometimes just straight old fatigue, where you get to a point on valuation where you think, what's your catalyst to go higher if earnings aren't going to come along? And if there is no catalyst to get higher, now might be the time to lighten up on equities. But to add 10% from where we are without earnings coming along, if you're 21.56 operating earnings, you're adding another 2.15 on the multiple. You're getting to 23.7 times operating earnings, which would put, as reported, 26 times. That is a stretched market on large cap. This is not small cap tech. This is a large cap. So I'm extremely cautious at these levels. That doesn't mean that I'm not taking long positions, but if you notice, all of the stocks that I've been looking at are at very low valuations. Now that doesn't mean in a correction that I'll be okay. I won't. I'll suffer just as much as the rest of the market will. But at these levels, I cannot commit to this market pushing to 22 times the forward earnings. And again, with all of the excesses starting to appear in different places. Now, a couple of places where there was no excess, Bitcoin just gave back all week, having trouble at 71, giving back to 66. There, I've also done the expert tour, where I didn't look for forecasts for Bitcoin. I wasn't looking for that, because the forecasts are all ridiculous. 500,000 by 2026, I'm hearing. Because of demand for ETFs. Every time I hear a price target, it's because it's demand for the coin, not because of increased activity on the blockchain, which is really what it's supposed to be about, right? Every time I search for applications on the blockchain, there are none that really exist that you would say, okay, well, this will do it. It's like, there's nothing there. The crypto was meant to be the reward for processing transactions on the blockchain, but now the crypto is the object. The blockchain just seems to be, the blockchain is for recording the transactions in the crypto, not the crypto rewarding the transactions on the blockchain. It's completely backwards. I still think the value of that is zero until there's a killer app. But again, going back to my theme here of where we are, we just seem to be so stretched, so priced for absolutely everything working out, and not just working out. It's not just priced for things working out, it's priced for things to get even better from things working out perfectly, that we're going to be even more perfect. And it is on almost every measure here at extremes. Also, let me just say something about GameStop, GME. I would not short that. I wouldn't buy it, but I wouldn't short it. Because they have $3 billion in cash now, which gives them a price somewhere around $10 on a cash basis. $10 of their price is pure cash. So you think, well, what could they buy? What could they invest that in? What interesting things could they buy in their space, or even outside of their space? You can buy a lot for $3 billion. You can invest in a lot of interesting companies at $3 billion. So you add some premium on for the fact that they may invest this wisely and maybe diversify away from the GameStop model, from just selling games. So I don't know that I would short this company. I don't know that I would buy it, but I don't know that I would short it when $10 is pure cash until we see how they're going to spend that cash. You got to give them some value for GameStop itself, and maybe you give it a $5 value, and then you got to give it some value for some potential that could come out of this, some potential cash flows coming out of this based on what they buy. Maybe throw another 5 to 10 on there. You get to 20 to 25 on just some kind of potential. So until we figure out how they're going to spend that $3 billion, I don't think this is a short. Again, I don't think it's a buy. But for those of you who think this is going to zero, not with $3 billion on the balance sheet and not with the potential to own something that is diversifying away from GameStop or to move into something that has significant growth in the game space that doesn't require the stores. I don't know. But don't short cash. It's got $3 billion, so I would just stay away from that one for now. I wouldn't be a buyer, but I wouldn't be a seller. In fact, if it did push down to $20, I think I might even sell the $20 puts, because I don't know that it would get that much far below 20. I think I would be a seller of the $20 puts down there until we figure out what the hell they're going to do with that $3 billion. Well, that's it for the week. One of the companies reporting this week, Lennar. Lennar is reporting this week. That is something all three of them do agree on. At least you agree on that. But if you're in the home building stocks, Lennar.